Hey, thanks for joining us. I'm Chris Hill, coming to you from Full Global Headquarters in Alexandria, Virginia, joined by Andy Cross and Jason Moser. Thanks for being here, guys.
Hey, Chris.
We're going to be taking your questions. We've got our stocks for 2020, and if you're looking for even more, just go to fool.com/YT. We've got a free report with our 5 top stocks for 2020. Again, you can check it out, fool.com/YT. Andy Cross, let me start with you. To this point, great year for the market.
Amazing.
Up around 25%. What stands out to you?
God, even more if you throw in the dividends there, Chris. You can't forget about the dividends there. Yeah, it's up more than 29%. That beats both the Russell 2000. Now the Nasdaq actually is a better performer, and the Nasdaq 100 is up 36%. So again, you just look at the market. Overall, one of the best yearly performances of the decade, in a decade that has performed very well. But really the big drivers are those big consumer tech companies, the Apples, the Microsoft, Facebook did really well after a rough last year. So continued kind of dominance by the large cap growth companies.
Yeah, Jason, I mean, you think back to a year ago this month, December 2018, worst December since the 1930s. So really great to see this kind of performance in 2019.
Yeah, it was a tough end of the year last year. We're not repeating that, thankfully, this year. And I mean, it does feel like the market's performing a little bit better than some of the companies are performing. But for the most part, businesses are still performing very well. And it's not just big tech. Chris, you and I were talking about this a little bit earlier today. My baskets here that I've put together are the War on Cash basket, Visa, MasterCard, PayPal, Square. That basket's had a great year, up 36% beating the market. The healthcare and wealthcare basket, which is United Health and Massimo and Teladoc and IDEX Labs, that's up 42% in beating the market. So it isn't just big tech. I mean, it really is something that's spanning all markets. It's just been a great time to be invested.
You know, it is interesting looking at the S&P 1500, which is the small, large, and the mids. That's up about 27%. The average stock, if you just threw a dart at those 1,500 stocks, the average stock is up 23%. So the average stock trailing the market, that's actually not too surprising. The 78% of those stocks have had positive returns and only 48% beating the market. So it is definitely skewed a little bit to the winners, though.
Yeah, and one thing that stood out to me earlier is looking up this data. Netflix, one of our favorite investments here. It's had a tremendous decade. Let's not take anything away. Hasn't been the greatest year for Netflix. I mean, up 20%, pretty good. It's still being outpaced by the market. So it's worth noting. I mean, these things ebb and flow a little bit, but just because a good business maybe doesn't have a great year doesn't mean things aren't still working out.
Well, and you drill down to some of the individual companies. I mean, I think one of the big stories, certainly when it comes to media and entertainment, the launch of Disney Plus, which had been pushed back for about a year and a half or so, seems to be off to a great start. That may have a little bit of impact on Netflix. But when we look back at 2019, Andy, we got to mention WeWork because in terms of the stories of the year, there were some big IPOs. Overall, I think IPOs had sort of a mixed track record, but it seems like the implosion of WeWork in the fall of 2019 really sort of pumped the brakes on IPOs.
Yeah, a little tale of two stories when you look at the IPO market, because for the first few months it was really good. Stocks had performed very well. Granted, a few months is such a short amount of time. And then a lot of concerns came out about WeWork as they filed their S1 and they started talking more about going public, and then just more and more scrutiny on that as a business because it had gotten so much publicity around its reach, its breadth, and then obviously its CEO and founder, Adam Neumann. But people started poking more and more holes at that, finding a little bit more concerns with the business and whether it could sustain through its money-losing operations, and did it have enough money to even sustain itself in the short term? And that really started puncturing a hole on the wider IPO market. And as we saw, WeWork ended up shelving its public offering, and now is in the spot where SoftBank is trying to sustain it with some debt funding for in the short term.
Yeah, what I think is really exciting about this too, it's going to be a nice byproduct from this WeWork issue. Seeing a lot of enthusiasm going through companies' S1s. And I mean, it's not just for investing nerds anymore, right? I mean, if you're interested at all in investing, I mean, all of that documentation, it's out there for you to peruse. It's just a matter of knowing where to find it and then actually wanting to go through and look at it. But I think seeing that WeWork S1, watching that whole process unfold, and you can see it on Twitter. I mean, that's a robust investing community. It's just more and more people, they're looking through this thing saying, I don't understand how, these numbers don't make sense. What in the world's going on here? It really, I think, is going to raise the bar for companies that want to go public here, 2020 and beyond. I think they're going to look at this WeWork example and say, you know what, we better make sure we have everything battened down here and we can answer all of the questions, because folks, I think now more than ever are trying to figure out how to poke holes in that investment. And that's not from a place of being negative, it's from a place of trying to get to the best investments possible, and that's stuff that we do every day here.
And it is interesting, just to review, I mean, that in January of a year ago, that was at a $47 billion valuation, driven a lot by excitement from SoftBank and from other investors. And now it's probably somewhere, it's definitely south of 10 billion. And now, like I mentioned earlier, they're trying to find some debt financing for it.
So before we get to your picks for stocks for 2020, let's go a little bit bigger picture. Jason Moser, what's something you're going to be watching? It can be a trend, an industry, but as we go into 2020, which obviously is going to be a year with more distractions than the typical year. We'll have a presidential election. We'll have the Summer Olympics. It'll be a little bit harder for investors like us to focus week to week. What are you going to be watching?
Well, for me, I mean, the back half of 2019 really has been all about augmented reality and virtual reality and mixed reality. For me, helping lead a service that's focused on investing in these markets, and it's really an exciting time because I think we're on the precipice of where this is really starting to hit mainstream. And ironically, I think we were always looking for those consumer implications for this technology, and what we're seeing is a lot of these companies are pivoting over to enterprise solutions and finding that really that's where the biggest opportunities lie today, or finding ways to implement this technology on the enterprise front. And so, I mean, when you look at the AR market, it's valued around $4 billion in 2017. Projected to hit $60 billion by around 2023. And I saw another interesting data point today from the International Data Corporation. They're saying that spending on AR and VR together is expected to hit around $20 billion, close to $20 billion in 2020. That's going to be up about 80% from 2019. And so we're going to see markets from retail to discrete manufacturing all benefiting from that spend. And so just coming from the perspective of studying that technology and understanding how it's affecting all of these different markets, that's where I'm really keeping my eye.
Andy, what about you?
I'm really interested in the small cap market. So if you look at small caps, not just the past year, but really over the last 5 years, they have underperformed their large cap. I mentioned the large cap growth really has gotten certainly a lot of the dollars, but they've actually had a lot of the performance. So the small cap market has really trailed the larger index over time. Small caps have been a really nice place to be an investor. So I'm looking now when interest rates have fallen now. We saw 3 cuts the past year. The valuations for small caps are the most attractive they've been in probably more than a decade. So I'm just thinking there's small cap opportunities. A lot of the market is not paying attention to that. Certainly a lot of the institutional market. So I think there's opportunity there in the small cap market. I'll talk a little bit about a small cap stock here in a second. So I think enterprising investors and investors who want to go someplace that other investors, other institutional, certainly big ETFs and mutual index funds are not going, I think the small cap market may have a good rebound here.
One last thing before we get to your stocks, and let's go big for a second, because we talked about the year that some of the big tech companies have had, including Apple, up nearly 80% in 2019. As these companies get bigger and we go into a presidential election, isn't it safe to assume that there's going to be more scrutiny and maybe even a louder drumbeat for some type of regulation on Amazon, Alphabet, Facebook, et cetera?
Yeah, I mean, I think that's reasonable. I don't think anything is going to get accomplished from it, at least not in 2020, because I think they've got enough to focus on just with an election and all of the mess that comes with that. So I think we'll probably see more of those ideas shake out after the election, but I think your point still holds, that these are companies with a lot of power by virtue of their size and their networks. And it's really hard to pick one out that is more troublesome than the other. I tend to look at Facebook as one of the more dangerous of the bigs out there, and that is primarily due to its network effects. But I think that you'll probably see some of these management teams ponder whether it's not worth maybe beating the regulators to the punch and maybe spinning something out. I wouldn't be terribly surprised to see Amazon, for example, volunteer, say, hey, you know what, for investors, we're going to spin out the Amazon Web Services side of the business because we can. I mean, just because you spin something off, that doesn't mean it's a net lose for investors. Oftentimes, it can be a net win.
I think that's a great point, Jason. The fact that companies now are, I think finally, these large companies are finally realizing they have to be ahead of the curve for as we know, the past couple of years, they may have been a little bit behind, and we've seen them hauled up, their leaders hauled up to Capitol Hill, trying to justify some of their business practice. So I think we might see a little bit more activity. I agree with Jason. I think 2020 will be a tough year for them to get from the political environment to making those big changes, but just from a hiring and practice perspective, making sure they are ahead of the curve in 2020 as opposed to behind it. I think we'll see more and more conversation on the conference call and from the businesses about this.
All right, we're going to get to your questions in just a second, but first, Jason Moser, let me go to you first. What's a stock you like in 2020?
Well, I'm going to give a shout out to my friends at Investor Place. They invite me every year to participate in the Best Stock of the Year contest, and so this is, I think, the 4th year I'm going to participate in 2020, and I've called out Wayfair. I think most people out there probably know what Wayfair is at this point. If you don't, any home renovation, or if you're into that home goods and furnishings, you probably have Wayfair boxes on your porch every week, like me. But I think that this is an interesting dilemma here because the business continues to perform very well. If you look at the most recent earnings results, revenue was up 36% from a year ago. Gross margin holding the line actually was up 40 basis points. They have active customers now 19.1 million. Orders delivered up 32%, and really the most important metric, the percentage of orders from repeat customers, is now at 67.3% versus 66.3% a year ago. And that matters because it just costs a lot to acquire new customers. So when they get them, they want to keep them. It sounds like Wayfair is keeping them. But there was a telling blurb from the call from CFO Michael Fleischer. He said, since the beginning of the year, more than 90% of our suppliers who are subject to China tariffs have raised wholesale prices, which have resulted in higher retail prices. As retail prices on the site fluctuate, we observed that our customers' consideration cycle gets disrupted and is effectively lengthened. So that's just code for saying people are putting off making purchases. And I think that was the primary driver of the 20% haircut that the stock took from that earnings report. If we can get some certainty or some positive headlines from the China deal here in 2020, I think that Wayfair stands to have a very good year. It should come back from this, and it's the stock that I chose for that contest, so I'll be keeping a close eye on it.
All right, Andy, what about you?
I like a little company called Globin. GLOB is the symbol. It's a global IT services technology consultant. They're headquartered down in Argentina, founder-led and run. They still have 4 of the founders that are involved in the business. It's a $3.6 billion business, generates about $600 million in sales. Their specialty, guys, really is focused on this IT consultant, and especially around digital services. So as more and more large companies, and small companies too, large companies go and look to expand their offerings and provide more of a digital experience, more software solutions, AR, AI, Internet of Things, IoT, just more digital overall. That's really Globin's specialty. They were founded in 2004, so they've been around for a little bit, but still relatively small in the space that's very large. The IT services technology, the digital services business, is expected to grow in the very high teens, 19, 20%. So it's a large market that they're playing into, and Globin is providing these services. They're growing at 25, 27% a year. They're already profitable for a small company. That's great. I'd love to see that. And they have high returns on capital, good investment behind them, lots of momentum, and it's not really all that followed. $3.6 billion valuation. Stock's done very well since it came public, up more than 700%, up 600% over the last 5 years. So I just look forward for the next 5 years, and I see good days ahead for Globin.
Jason, one more before we go to the audience?
Well, I know Dylan behind the glass here is going to love this pick. I mean, you got to go with Adobe. It's one of the recent picks for our augmented reality service, and I think that, it's easy to dismiss this company because it's so big, and maybe you think the low-hanging fruit's been picked. I would beg to differ. I mean, this is a company that still has a lot of room to grow. I mean, this is, for all intents and purposes, just the #1 creative software provider out there in the market today, but they are going so far beyond that. Another company we talk about a lot, Docusign. Adobe's making a lot of investments in that document cloud that they have, and so it all just leads to this software behemoth that's recording 85 to 90% gross margins, a tremendous balance sheet, all of the opportunity in the world, still growing their top line at around 20%. Management doing a great job bringing that down to the bottom line. I just expect to see plenty of good days ahead for Adobe.
All right, if you're enjoying the video, please consider giving us a thumbs up. It helps other people find the video. And again, go to fool.com/YT if you want our 5 top stocks of 2020 report. It's free. You mentioned Docusign up 80% year to date. The Trade Desk up 115% year to date. Those are stocks that the Motley Fool actually recommended before 2019. So again, check out the free report at fool.com/YT. Let's get to the questions. A lot of great questions coming in from the audience. Doug asks, does anything look as promising as the Trade Desk did this past year? Man, that company was just snacking all of 2019.
Snacking indeed. I mean, yeah, listen, I mean, the nice thing about the Trade Desk, it's it's profitable, right? I mean,
Yeah.
you find a lot of these SaaS type businesses out there that are all really exciting, but they're missing that one really important part, and that's profitability, and the trade desk is there. If I'm going to look at a business where I feel like there's still a lot of optimism and excitement there, I mean, certainly Docusign is one. I mean, I own it personally. I think that they've really set themselves a great table for 2020 and beyond, particularly on the small and medium-sized business customer, and their mobile presence is tremendous. But, I mean, golly, I could probably pick another 20 names out of the hat. I just don't have enough time to do it.
Yeah, it's very interesting. For a year, maybe 2 or 3 years, Trade Desk, the stock didn't really do a whole lot. It kind of fluctuated. So it was just one of those times where you could have bought it. The valuation was a little bit much more reasonable. It was in the per stock price was in the $50 to $75 range at that point. So, you might see companies like the Trade Desk, the stocks just kind of stagnate. Jason, you kind of mentioned sometimes, like with Wayfair, the businesses do well, and the stocks in the short term kind of stagnate. Investors have to understand that. But certainly, I still think looking forward and the space that Trade Desk is playing, and it continues to be one of my favorite stocks in our universe that we follow, and our analysts overall still have a lot of confidence in it.
Yeah, and I think probably one that pairs pretty well with the Trade Desk, and one that seems like it's having a little bit of a tough end to 2019, Roku. I think this was a pretty misunderstood business, and I'll humbly suggest that I misunderstood this business when it first went public, because it's far more than just a hardware provider. I mean, they really are playing into that market of on-demand video, particularly ad-supported on-demand video, and being kind of that neutral ground, right? The Switzerland of video streaming, so to speak. And it's really working out for them. So they're not to that profitability that we're looking for either, but wow, a tremendous installed base. Users tell us they love the product, and they've got some great technology, made some small little acquisitions along the way in 2019. I could definitely see the market understanding this business a little bit better in 2020, and that working out well for investors.
Ming asks, after a year like this one, is it time to lock in some gains? Great question, and a natural question, I think, anytime you see a stock do well in your portfolio, to think, well, I've made some money, maybe I take a little off the table.
Yeah, it's really interesting. I was looking at the facts overall from the market, and we still have $3.4 trillion sitting on cash in the sidelines. So we've seen a lot of the money, in my opinion, a lot of the investment money that's kind of come into the market has come in institutionally, not really from a retail side. So there's still a lot of these tailwinds that kind of are behind businesses in America. And if we can get some continued resolutions around some of the bigger macro situations, you still have a lot of benefits behind long-term stock ownership. That being said, depending on how your portfolio is shaping up, and depending about your own personal belief with some of the your sleep number, to be able to where your portfolio is, what the allocation level. If you have a stock that's at a level that is a little bit too high for your allocation, it's a personal preference, but maybe 10, 20%, maybe it depends on who you are. Taking a little bit of money off the table might be a good thing. I would encourage you, though, not to abandon certainly not all your stocks, and even individual stock, because the best stocks tend to continue to perform the better over the long term.
Yeah, I think regardless of what you do, take a very measured approach. I mean, it's not something that you have to do all at once. And when I think about this, whenever I get this question, I always go back to this lesson my dad taught me years and years ago: is you'll never, ever buy at the bottom, and you'll never sell at the top. Just get used to it and go on from there. If you feel like you need to raise a little bit of money, or if you feel like you've got a little bit too much invested and the risk tolerance in there for you, it's understandable to want to raise a little bit of cash and get out of the game, but do it in measured approaches.
Yep.
Sandeep asks, when buying smaller companies, should investors be concerned about them getting bought by a larger company? Good question, and you mentioned Docusign. I mean, there are a lot of people, including you, who think 2020 can be the year that Docusign gets acquired, maybe by Adobe.
It could. I mean, that's my reckless prediction, so it is a reckless one. And I mean, I could see it happening because I think there's a lot that Docusign has that Adobe would like to have. I don't know that I would ever worry about it. I just wouldn't buy a company based on an acquisition thesis, and I'll just leave it at that.
Yeah, I think I would definitely not be concerned about it. Sometimes we have these great companies that are taken out at a premium price, which we hope for. And sometimes we say, oh gosh, it would have been great to have that stock in our portfolio for the next 5 years. I think when you go in to buy these positions, what you want to buy in is thinking about that long-term performance. Think about 5 years and where the companies will be, and that's the way you want to be able to buy your stocks.
And there are examples out there is when a little company gets bought by a bigger company, and you can still win, right? We talk about this all the time, Chris. Zoom, right? The financial remittance company that, man, I love this business for a lot of reasons, and PayPal just came in there and just took it right away from all of us, and I didn't really feel like they got it at a premium either, and that kind of stunk, but you know what? I own PayPal shares too, so at least I'm still part of the Zoom family, and that makes me feel a little bit better.
Austin asks, two of the biggest trends seem to be AI and streaming. Jason just mentioned Roku and Docusign. Are there any other stocks to watch in those spaces?
Well, for the stream, we talked about the trade desk. I think on the streaming side, trade desk is really interesting because they are playing in all the connected television market for advertising. And a lot of that connected television is going to be driven by advertising growth. And it's not just by subscription businesses, Disney, Netflix, and the like. So a lot of that will continue to be driven by advertising. So I think trade desk is a play into the streaming spot as well.
Well, and speaking of that, if the reports are to be believed, in 2020 Comcast is going to launch Peacock, which is their streaming service, and the early reports right now are that they're going to come out with a $5 a month package, but that will have ads in it.
Yeah, and I think I even read where they were considering just having it fully ad supported. So, well, I guess we'll have to wait and see for that. I mean, at least, you know, they'll have the office to try to help get that thing rolling. But yeah, I mean, when we talk about AI, one of the names that immediately comes to my mind, and you know, I wish we had Seth Jason here because he runs our AI service. But Splunk is one of those companies out there trying to make sense of all of that big data, right? That big machine data. Splunk has really built some tremendous solutions to help a lot of enterprises do that. I think that they're making a lot of waves and will continue to succeed.
Yep.
A few people asking, when do you guys stick with a stock that's down, and when do you cut bait?
It's a really good question.
It is, and here's my evolving kind of learning as an investor, as we've been doing this for many years, is I really, and I have a couple stocks that are down this year, and I'll probably take a few tax losses on them, but generally I really give my stocks a lot of room, even the ones that are down, because we've seen time and time again at the Motley Fool, those stocks that are down tend to rebound. I mentioned even some of them, even the stocks like Nvidia, Adobe, I mentioned the trade desk, Priceline is a great example. A lot of these stocks at some point, they will fall, they'll fall substantially, 20, 30, maybe more from their highs, and then you look back in 2 or 3 years they've rebounded, or maybe 5 years. It just depends. Sometimes they go stagnant. So my inclination is to really give these companies some room for better days. But there are times when you're like want to maybe take some tax loss harvesting on it, and for your taxes, that's okay. But tend to really hold and give them some patience.
Yeah, this reminds me of an interview we just had recently with David Gardner on Motley Fool Money, and he said something that really stuck with me is he's becoming even lazier about selling, I think is what he said. and I really appreciated hearing that, because it just, at the end of the day, like you said, if you give them time, these things a lot of times they do come back, and he is selling less and less and less. And I'm thinking about this with TripAdvisor. I still hold a few shares of TripAdvisor in my portfolio. It's performed horribly. It's just been a bad investment. I can't bring myself to sell it. I'm trying to just be lazy. And so I think I always try to give myself one more reason to maybe think about hanging in there. But, you know, they're tax loss reasons. Maybe you feel like you could put that capital to better use somewhere else. Everybody's got their own sort of reasons for doing things.
Speaking of stocks that have had stagnant periods, Bill asks, Microsoft has had a great run. Can it keep going?
Yes.
Yes, absolutely.
Fair enough.
Yes,
we'll move on
that
from
one.
there. A few people asking about Chinese companies. What do you think about them in 2020? Are there any Chinese stocks in particular that you guys like?
I keep my eyes on just the behemoths in the space. For me, it's the usual suspects. You look at something like a Baidu, or, I mean, perhaps an Alibaba or a Tencent. Yep. There's just so much we don't know about that market. There's information we can't glean. There's a cultural divide there. There's just so much we don't know, even when we think we know it. Boots on the ground research doesn't really add up to as much as you think it might. So for me, we live in such a global economy now, and so many of these wonderful businesses have exposure to China. I mean, look at Apple, for example. They're bringing 20% of their revenue from China, 30% of their operating profit alone. Plenty of opportunities out there to invest in businesses that are getting a lot of money from China that aren't China domiciled, and that means we're going to get better information to be able to make better decisions.
Michael asks, I'd like to hear your thoughts on Tesla. It's a controversial company, and I know some people in the Motley Fool universe like it. Others are staying far away.
Yeah, my feeling on Tesla is it tends to be a stock that gets so much publicity, and rightly so, around its founder Elon Musk. Very dynamic personality, started the business, and very controversial. There were a lot of headlines this year that I think started to swamp the real long-term potential value for Tesla, for its solutions. We just saw what it released with its truck initiative. So much of the stock, I think, was just tied up into the, even more so than normally, the cult of Elon Musk. But when I think about the next 5-10 years of where the world is going, we should be cheering for Tesla and cheering for the solutions they want to do. It is one of the most divisive stocks among our team, and it'll continue to be a stock in the marketplace that is extremely volatile. I just think long term, this is the business, we've been saying this for a few years, you can own a few shares and just let it kind of ride, sit in your portfolio. You have to be able to go with the ups and downs of Tesla.
Yep.
Few people asking about 5G, and perfectly understandable when you think about all of the coverage 5G gets. And some of that coverage is bought by the companies themselves that are investing in it. I mean, TV ads about 5G. Do you guys see a good way to invest into this trend?
I personally do. I mean, 5G is I think people think there's probably a couple of ideas that pertain directly to it. I think it's less about 5G and all of the byproducts that we're going to witness from 5G connectivity. And so, I mean, you've got AT&T and Verizon building out the networks, but I know what I'm studying and what I'm finding in AR, and I know that what Seth is finding in the AI services, that all of these companies are going to benefit from these 5G networks. And so it's all about what's going through these networks. And then I'm finding these companies through the augmented reality, virtual reality, mixed reality spaces, artificial intelligence. It's just going to expand the bandwidth of the information that can flow through these networks. And that's going to play out big time, I think, not only on the consumer side, but the enterprise side as well.
Yes.
Speaking of AT&T, Brian asked, what are your thoughts on a dividend player like AT&T as a long-term buy and hold stock?
It's hard to argue against it. I mean, we all need to be connected, right? Whether it's AT&T or Verizon. Ben Ra, one of our analysts here, he and I have talked about this a lot, and we always kind of came back to Verizon over AT&T for a couple of reasons. But I think that they're both businesses that will be in very good shape because the consumers, we rely on them for connectivity, and I don't think that need is going to go away, at least not during our lifetime.
And I'll just say for the dividend stocks, we talked about this on YouTube Live, our dividend special. Dividends continue to be with a low rate environment. If you can find companies that, whether it's a dividend aristocrat that has increased dividends for 20, 25 years or more, but companies that have low payout ratios, pay a dividend, have the potential to increase that dividend over time. I think dividends continue to be a big opportunity for investors. Get a little income, get some capital appreciation, and you tend to get a little bit more low volatility stocks too.
Love those dividend aristocrats.
Yeah, love them.
Absolutely, and if you're looking for more information, after you're done watching this video, go ahead and watch the Motley Fool's video on dividend investing in our channel. A lot of people talking about Twilio in the chat room. Are you guys still bullish on Twilio?
Yeah, I own it. I still own Twilio. Jeff Lawson, the CEO, the founder of Twilio, what they are doing in the space. They made a big acquisition recently. I think that continues to be a place. The stock has kind of flatlined, struggled a little bit recently, but when I look long term at where Twilio is going, the kind of market that they are going after, I still continue to like that stock, and it continues to be a holding in many of our services.
Rhonda asked, what do you guys think about Beyond Meat? Pretty tasty. A couple of times I've had it, but I'm not interested in the stock.
Yeah.
Yeah, I tell you, I'm not a vegetarian. I'm not really all that interested in it. I mean, I think there are a number of different ways to curb meat from your diet. Having tried at least one of Beyond Meat's products, I thought it was okay. I don't know that I would go buy it again. It was the bratwurst, by the way, Chris. And, I'm a bratwurst kind of guy. I feel like it's another one of those companies I think you can root for, kind of like you were talking about with Tesla.
Yeah.
See, I think there are a lot of reasons why a business like this can have a positive impact on our lives and on the planet. So from that perspective, it's the type of business I root for. The valuation makes zero sense to me. It's one where I just can't get behind it for the valuation alone. But it's a business I continue to follow. It's a business that I root for because I think that is where we are headed in the future, trying to find new ways to bolster our food supply chain for what's really a growing global population.
Last question before we wrap up. Austin asks, if you had to put your entire life savings into one company over the next 5 years, which one would each of you pick?
Higher life savings over the next
great.
5 years.
I'd go with Starbucks, just
I was
because I
just
know
going to say, man,
coffee's not going to get disrupted in the next 5 years.
Is it? No, it's not going to get disrupted. You know what? I'm going to stick with one of these names that I dropped earlier. I would put my life savings in Adobe. I feel very confident that in 5 years they're still going to be doing really well. And hey, listen, your capital shouldn't disappear with a company like that.
Yeah, a company that we just have come to know and really respect is Shopify. The valuation the stock has performed so well, and the valuation has gotten to be on the high side, higher than what it was. But I just think what Toby is doing, the CEO and founder of Shopify, and the platform they are building, and just when you think about the entrepreneur, Jason, we've talked about this with Etsy and Shopify and others. The growth of the entrepreneur and the entrepreneur economy, Shopify continues to superpower that. And I just think that business over the next decade is going to be a really good investor.
Yeah, and I was talking with Aaron Bush about this earlier today. The valuation is a little crazy. I mean, I own Shopify as well. Yeah. But when you think about the market it serves, I mean, we know commerce isn't going anywhere. It's going to grow, and that commerce market is resilient. And I think that's something to keep in mind. So while the valuation's a little bit tricky to come to terms with, recognize that this is a large and growing market opportunity that is not going anywhere, and Shopify has done a great job of really taking their share early on.
All right, Andy Cross, Jason Moser, guys, thanks for being here.
Thanks, Chris.
Thanks so much for watching. Thanks for giving us a thumbs up if you like the video. It helps other people find it, and check out that free report, Top Stocks for 2020. It's free. You can find it at fool.com/YT. Thanks again for watching. We'll see you next time.